Hello and welcome to the latest episode of Damien's Market Update. Now, this is the show where I talk about what's been going on in investment markets and what to look out for in the days, weeks and months ahead. Now, last show I concluded by stating that overall we're heading into the second half, or we were heading into the second half, I should say, of 2023 with the same nagging concerns that haunted markets at the start of the year before equity markets rallied strongly. But the only difference was that more investors had returned to the market chasing the rally, or in other words, greed was trumping fear compared to the start of the year. But the fly in the ointment was the strength of the pound, which was hampering returns not only of the FTSE 100, but also your overseas holdings within your portfolio. Because of that currency conversion, when you take that into account, it often meant that your returns were hampered. Now, this all was reflective of the main theme that's been driving stock markets throughout 2023, which is the policy divergence between key central banks. And generally speaking, the closer that investors think that a central bank is to loosening monetary policy or stopping its tightening cycle, that means hiking rates, so stopping hiking rates, then the better their domestic stock markets have tended to perform. But of course there have been other themes bubbling around in the background that do pop up from time to time, like Chinese growth fears, geopolitical worries, and of course we've also had earnings season which has largely passed without any major incident. Now, if you want a good example of this, so like a microcosm of the combination of central bank policy expectations with these other themes, then you just need to look at the hours of trading after the official UK figures for inflation were released last month. Now, they were lower than expected, and it caused the FTSE 100 to explode higher by 1.9% in one day, which was the highest daily gain since November. We also saw property shares surge higher as expectations of inflation fell going forward, but also the expectation of where the peak base rate from the Bank of England would be. But the latest inflation data, which has just come out as I make this show, is slightly less rosy. It's marginally higher than expectations. So keep an eye on what happens in investment markets in the coming hours and in the next couple of days to see the dynamic that occurs between different asset classes. You can learn a lot in these periods. But it isn't just stock markets that have been shaken by economic data releases of late. Bond markets have been too. After last month's inflation data, we saw a huge swing in the UK gilt market. In fact, the 10-year UK gilt yield tumbled. It did pick up again, but it did fall to its lowest level since early June. We also saw the pound fall back below that key $1.30 level, which obviously gave some respite to UK investors. But it wasn't just in the UK where inflation data pleasantly surprised. It was also in the US, which meant that investors rushed back into the market, buying any dips. And so July did start off on a bit of a bad note, but it quickly turned around, and we saw not only US stocks rally, but that bled over into global equity markets. So what we saw in July was global investors deciding that central banks perhaps have turned the corner in their fight against inflation, particularly in the US. But following a stellar July, which built upon an already impressive start to 2023 for global stock markets, August has started on the back foot, with a weaker pound helping to soften the blow a little bit. If we look at the numbers, I can look here. For example, the best market at the moment is the FTSE 300 in Europe, so that's down about 2.5%. That's a broad measure of European equities. Dow Jones is down 2.8%. This is all in local currency terms. We've got the DAX down almost 3%. The S&P 500 in the US down 3%. And if we go down, the FTSE 100 is down 3.61% so far in August. And the worst performing index is the Asian ex-Japan index, which is down around about 5%. And we've seen a lot of weakness in Chinese equities too. So what is happening here? Well, a trickier month was to be somewhat expected, not just because of the strong rally we've seen year to date, but also from a seasonality perspective. So August is notoriously tricky for equities. Historically, the S&P 500 has fallen 0.2% on average in August since 1945. This is worse than the average performance of all other months except for September, which has an average decline of around 0.7%. There's a similar story of August weakness for the Nasdaq, which had been up 37% year to date as we went into August. But there's also a similar weakness story in August for UK equities, with the FTSE 100 falling on average 0.4% in August since 1984. So the question becomes, will dip buyers return and rescue the stock market like they did in July? Well, it's too early to say, but there are some notable headwinds starting to blow. So while equity markets have fared well in recent months, the same can't be said for bond markets. Now, the 10-year US Treasury yield has exploded higher in recent weeks, and it surpassed its 2022 high. Now, why this is relevant is because when yields rise, the price of bonds fall, as do the value of bond funds. But rising yields could eventually cause a problem for the stock market. Now, there has been a fairly tight correlation between the fortunes of the 10-year US Treasury yield and the tech-heavy Nasdaq 100 over the last couple of years. This is broken. So what all that means is that if that correlation is going to reassert itself, then we're likely to see US tech stocks collapse, or we're going to see 10-year US Treasuries rally, which means that their yields will fall. Right now, we're seeing more of the tech stock weakness. Also, we've got the US dollar index. That's woken up from its slumber and it's rallied significantly. And when the direction of the US dollar index changes, we usually see a ripple effect across other asset classes. So, for example, if the US dollar index keeps rising, then it will continue to be a headwind for US stock markets, and therefore, ultimately, that could bleed over into other stock markets globally. But the US dollar index has wide implications for other asset classes too. But we have seen some rotation into defensive equity sectors globally, so maybe that's a lifeline for the bull market in stocks. But the weakness we've seen could just be a bout of profit taking, because after all, we've had some great performance so far in 2023. But investors' nerves are starting to show, because if you look at the Fear and Greed Index, so the CNN Fear and Greed Index, if you Google that, we'll put a link to that in the notes of this show, you can see that that's fallen significantly from showing extreme greed was driving markets last month to a more balanced perspective. So fear and greed are much more balanced at the moment. So fear is creeping back into the market. So that fear is being fueled by a number of things. Some of the things I mentioned earlier have been bubbling in the background. China data, so economic data is suggesting more weakness in China. That has spooked investors. And we've also seen a downgrade by some rating agencies of US banks. So that has spooked markets again. So we've seen some weakness in bank stocks. The message is that there is a pullback. Fear is starting to return to the market, but if the bears are going to drive this market lower, then now is their chance. So that is it for this episode of Damien's Market Update. If you found it useful or you've enjoyed it, do make sure you hit that like button, but also subscribe to this channel.